Let's get to our first discussion on the show today as we focus on the fixed income and equities market. Local investors have continued to dominate trading activities at the Nigerian bourse, controlling 85.3% of total transactions, leaving foreign investors with 14.7%. This is as a result of the unprecedented exit of foreign portfolio investors due to uncertainties in the economy, such as political risk, inaccessibility of foreign exchange, and other global trends. According to the NGX data on foreign and domestic investors' participation in the equities market at the end of June this year, the breakdown of the market participants in the period under review shows domestic investors have primarily driven the market. The impact of the electionarian activities on fixed income and equities market in Nigeria remains one of the biggest conversations, as the impact is mostly felt in the second half of the penultimate election year, and such pre-election years in Nigeria are characterized by tension and uncertainties ahead of the general elections, with adverse consequences for the economy and the equities market in particular. Joining me from our Abuja studios to discuss the transaction base and activities of the fixed income and equities market, I'm being joined by Professor of Finance and Capital Market at the Nasarawa State University, Kefi. He's also the president of the Association of Capital Market Academics of Nigeria, Professor Uche Walike. Good afternoon, Prof, and thank you so much for your time. It's good to see you.
Thank you very much, Tolu. My pleasure.
Yes, let's get talking first, because I went through that very brilliant document that you use for presentation, association I also belong to, that's FICAN. But let's first start with the determinants of a financial market performance. You identified GDP growth and all of that. Can you let us understand what you mean and what are these determinants?
Yeah, thank you, Tolu. Well, you can categorize them broadly into external and internal factors that influence securities prices generally. You know what we are going through at the moment, especially in terms of the, if you like, external shocks. The world, the global economy is just emerging from the destabilizing effect of COVID, and we before us is the Russian-Ukraine conflict, which, as you know, has resulted in economic headwinds for many economies. In the U.S., as we speak, the Federal Reserve, that's the U.S. Central Bank, has been normalizing interest rates, increasing interest rates, because it intends to bring inflation down. Inflation rate in the U.S. has reached unprecedented levels. In developed economies, in the Eurozone, it is the same story. Germany, too, is battling with a high inflation rate. Just recently, we read that the finance minister in Germany is talking about a 10 billion euro inflation tax relief to help the citizens there, cope with the situation. So it is devastating, all over, and that's majorly because the energy costs are rising on the back of the rise in international, the crude oil price. The Chinese economy, we know, is slowing down, partly on account of this, partly on account of their zero policy on COVID, where we hear in some cities they are still experiencing lockdown, and all this will now be exacerbated with the tension that China is also having with Taiwan. Globally, the world economy is challenged. As you know, IMF has also revised downwards their growth estimates, for the world, partly on account of all this. So these external shocks affect securities prices, no doubt. Then internal factors Of course, we have a domestic price level to deal with. Inflation rate in Nigeria today has been on the rise. The last figure we have 18.6 from the National Bureau of Statistics. That's now way higher than the returns from the equities market. Returns from the equities markets to date, from January to date, is around 17.6%. So it's below inflation rate. What it means is that the returns from the market is now in the negative territory. Real rate of return is now in the negative territory. So, and of course, where you have high rate of inflation, investors will not want to, put their money in an investment that won't give them returns that are in excess of inflation rate. So, inflation rate is a major factor affecting security prices. Ditto for interest rates. Security prices, particularly the equities market, doesn't do well when you have a high interest rate environment. And in our own case in Nigeria, it's been exacerbated, by the external shocks I talked about. If the Fed is increasing rates, developed economies are increasing rates, what you find is capital now leaves Nigeria, emerging economies, to the US, where rates are being increased. And that's why, partly why the MPC in Nigeria here responded to by increasing the own monetary policy rate from 13% to 14%, all in a bid to halt the capital flow reversal, as a result of the Fed normalization, interest rate normalization. So interest rate is also there. And of course, exchange rate is another factor that affects securities prices, again, particularly equities. Where you have high volatility in the exchange rate, it doesn't make room for foreign investors coming in. You said it there in your background report that foreign investments in Nigeria have been on the decline, partly on account of exchange rate issues. So generally speaking, you have these macro factors, impacting securities prices. But in at the micro level, if you like, company performance is for me the major determinant of the long-run performance of the equity market. If companies that are quoted on the exchange, for example, are doing well, you should expect that in the long run, their share prices will appreciate, even if they experience short-term drop in the share price as a result of some of these issues that I've mentioned. But fundamentally speaking, companies' share price, happen to be a major factor. So, in a nutshell, these are the factors that shape securities prices, and investors, need to be aware of them. Of course, to be in a better position to know how to engage the market.
Interesting start there. But let's now all look at what's been happening before now in the pre-election year and how it basically affects the market. That's both the equities and the fixed income space, because it's always associated with tensions, uncertainties, investors sitting on the fence and all of that. So will anything different happen in 2022?
Well, I don't see any much departure or a significant departure from previous performances. If recent history is any guide, again, we are in a VUCA market. VUCA is an acronym that stands for the V there is volatile, the U is uncertain, the C is complex, and the A is ambiguous. So we say we are in a VUCA market, we are in a VUCA world, and the VUCA is usually associated with, in Nigeria, with pre-election years, penultimate years. If you look at what has been happening since 1999, when we embraced the, if you like, civil rule one more time, Since 2002 up till now, we've had 6 penultimate election years. And in the 6 penultimate election years, it will interest you to know that usually the first half of the year, January to June, of each of those penultimate years, including 2022, which is also a penultimate year, each of them has recorded positive performance. In 2022, for example, you know that January to June equities market performance was positive at 21.7%. But another interesting thing to note is that, again, for the second half of the penultimate election years, we have recorded negative equities market performance. So, and it's not just sheer coincidence. For me, it's largely attributed to the fact that the second half of a penultimate year is usually when political activities heighten. Primaries, political campaigns, and so on, and they tend to, engender, if you like, that VUCA environment. I talk about VUCA, the uncertain environment, volatile environment, and of course, uncertainty now leads to, volatility. That is swings in securities prices. If you look at what we are even witnessing this year, as I said, January to June 21.7, but what have we seen in the month of July? Month of July closed negative, and even in August, as we speak, it's been mixed. So you now find that since between July and now, the market has actually been negative. And if you if you want to extrapolate that or amplify that, we are most likely going to have negative market performance between July and December. And as I said, it may not be unconnected with the political activities associated with a penultimate pre-election year. Look at the pressure we are witnessing now in the forex market. Okay, why are we witnessing that pressure? It's also partly political related. Speculative attacks on the naira today has a lot to do with politics. So you find that generally speaking, you have these headwinds or these challenges, associated with this period, and that's why I think or why I am foreseeing a situation in which securities prices will dip within this period. Now, if you also look at the fixed income market, particularly the bonds market, if you use the 10-year bond yield, if you take the 10-year bond yield as proxy, for what we are discussing, you will also realize that bond yields also tend to be higher, this period, especially. Okay, and why is that so? It's primarily so because it's also associated with, increase in the demand for money, increase in government borrowing. When government borrowing is on the increase, what do you expect? Interest rates are driven up. And if interest rates are driven up, you should expect that bond yields will also be high. And again, with high rate of inflation, what do you expect? You expect the central bank to increase monetary policy rates, to tighten monetary policy. So the interest rate environment will go up. So all these are linked to political activities. They are linked to the uncertainties, tensions associated with an election year. But I must advise Tolu that this is not the time to panic. The best strategy in a VUCA environment, in a volatile, uncertain, complex, and ambiguous environment, which I've called VUCA, is not to panic, it's not to sell. Okay, this is actually the time for investors to identify, good companies with good fundamentals, and then buy in such companies, take positions in such companies. This is also the time not to speculate too much in the market, not to try to market time the market. This is the time to adopt, a longer term perspective, with respect to the market. That's my advice to investors. Stay on course, don't panic, don't sell, possibly identify good stocks and buy. And then, of course, ultimately ensure that any portfolio that one has is well diversified. Of course, investing in this period should be based on proper advice, and portfolio managers understand what I mean when I talk about portfolio, diversification. Head or tail, I'm optimistic that this wind will eventually blow away, and usually the following year we usually see a rebound, in market performance.
Okay, Prof, let's wrap up on this note. Portfolio rebalancing is something that you also opted for, saying that we could look at other sectors. Now, what are you thinking? What sectors do you think investors can, focus on at this time? Let's wrap up on that note.
Yes, it's natural for investors to migrate to, safer asset classes, during this period, and that's why you find, rebalancing in favor of fixed income securities. If fixed income securities are rising, especially government securities, which we know, or at least we theoretically we say they are risk-free. So, of course, I expect to see more increased uptake in government securities. So, rebalancing in terms of migrating from equities to fixed income, should be expected. As I said, other asset classes that are considered safer, but of course not. I wouldn't advise anybody doing currency. By that I mean trying to say you want to buy dollars because you think the naira will get devalued. And I'm happy the central bank has made it very clear that there is no intention to devalue the naira. Of course, that would be doing so would not be right, right for the economy. So that kind of message should eventually, strengthen the naira, particularly so when we realize that the central bank at least has relatively sufficient reserves, to defend the naira. And I'm happy that even in the parallel market now, as we speak, the naira is appreciating, and the gap between the parallel and official market, is closing. So that rebalancing is actually with respect to, securities, really, asset classes that are considered safer. So, of course, if you're managing a portfolio regularly, you're expected to revise, you're expected to, evaluate your portfolio and, do some sort of add and drop. That should be expected.
All right, I must thank you so much. Professor Uche Waleke is the professor of capital market at the Nasarawa State University, KEFI. He's also the president of the Association of Capital Market Academics of Nigeria. Thank you so much. It's always nice having you join us on Business Nigeria.
Thank you.